January 30th, 2025. 1.8 billion ounces of silver traded in a few hours on the COMEX. That's not a day's production. That's not a month. That's 2 full years of every silver mine on Earth dumped in one session. And while that paper avalanche crashed the price 40%, physical dealers saw demand explode to 250% of their all-time records. SD Bullion processed more transactions in one day than entire months of 2025. This is not a market. This is a controlled demolition. And if you understand what I'm about to show you, you'll realize we're not watching a price correction. We're watching the final act of a script that's been performed 3 times in recorded history. Same pattern, same sequence, same outcome. The Roman Empire didn't fall to barbarians first, it fell to accountants. In 301 AD, Emperor Diocletian issued the edict on maximum prices, capping over 1,000 goods and services because inflation had spiraled out of control. Why? Because for 2 centuries, Rome had been debasing its currency. The silver denarius went from 95% pure silver under Augustus to less than 5% under Gallienus. They melted down coins, mixed in cheap metal, restamped them, and pretended nothing changed. But the bakers knew, the soldiers knew. Everyone who touched actual metal knew the empire was lying. By the time the edict was issued, it was already over, verified. Fast forward to the Dutch Golden Age. In the 1600s, Amsterdam was the financial center of the world. The Dutch guilder was the reserve currency. Then came the wars, Anglo-Dutch wars, War of Spanish Succession, endless conflict funded by endless debt. The Dutch East India Company, once the most valuable corporation in history, began issuing more shares than it had assets. By 1780, the guilder had lost its status. Britain took over. The transfer wasn't announced in a press conference. It happened in ledgers, in bank vaults, and the quiet decisions of merchants who stopped accepting Dutch paper. Check. The British Empire controlled a quarter of the globe. The pound sterling was backed by gold enforced by the Royal Navy, but 2 world wars shattered that system. Britain entered World War I as the world's largest creditor nation. It exited as a debtor. By 1944, at Bretton Woods, the United States took the throne. The dollar became the reserve currency, backed by gold at $35 an ounce. Britain kept the furniture, but America owned the house. The pound didn't disappear overnight. It just stopped mattering. Verified. Now apply that pattern to today. The United States national debt is $36 trillion and accelerating. We are adding $1 trillion in new debt every 90 days, not annually, every single quarter. The debt to GDP ratio is 125%. When Paul Volcker raised interest rates to 20% in the early 1980s to crush inflation, the debt to GDP ratio was 30%. He could afford to do it. The economy could survive it. Today, annual interest payments on the debt have already crossed $1 trillion. That is now approaching the single largest line item in the federal budget, surpassing defense, surpassing Medicare. If the Federal Reserve tried to pull a Volcker today and raise rates to 10%, let alone 20%, the interest expense alone would consume the entire federal budget. There would be nothing left for government operations, for salaries, for anything. The math doesn't care about intentions. The math makes the decisions now. And here's what they're not telling you. On February 2nd, the Trump administration announced a $12 billion strategic mineral stockpile. Lithium, cobalt, rare earths, nickel. The official narrative is that this is about countering China, about securing supply chains for EVs and defense. Notice what's missing from that list. Silver. But anyone who understands industrial demand knows that silver is the ghost in that machine. You cannot build solar panels without it. You cannot manufacture electronics at scale without it. EVs require it. Defense systems require it. 5G infrastructure requires it. The energy transition the West claims to want is materially impossible without silver, yet it's not mentioned. Why? Because governments don't announce what they're hoarding until they've already hoarded it. When a government begins stockpiling physical materials, it's not because they expect prices to stay stable. It's because they know supply risk is existential. You can manipulate paper prices with leverage and derivatives. You cannot conjure physical metal out of a spreadsheet. We are not at the cliff. We have already walked off it. The ground just hasn't appeared yet. Let me show you exactly what happened on January 30th, because this is where the desperation becomes undeniable. 1.8 billion ounces of silver contracts traded on the COMEX. To put that in perspective, global annual mine production is roughly 800 million ounces. They traded more than double the entire world's annual output in a few hours. But here's the smoking gun. By the end of the day, 1.127 billion ounces worth of contracts had been closed. They weren't buying silver. They weren't taking delivery. They opened massive short positions, dumped them into the market to crash the price, then exited. Volume hit 345% of open interest. Normal trading days see maybe 100%, occasionally 120% on volatile sessions. This was more than triple normal activity, and it was concentrated in the March contract. March is a primary delivery month. That means contracts expiring in March can demand physical metal. And the COMEX registered silver, the actual metal available for delivery, sits at just 104 million ounces. They dumped 1.58 billion ounces of paper silver while holding just 104 million ounces of physical. If even 10% of those contracts had stood for delivery, the system would have shattered. This was not market forces. This was a preemptive strike to avoid a delivery crisis. And on the other side of that paper massacre, the physical market told a completely different story. SD Bullion recorded 2.5 times their previous all-time record in transactions. The prior record was set during the Silicon Valley Bank collapse in 2023, one of the most acute financial panics in recent memory. Friday exceeded it by 150%. Revenue in a single day surpassed entire months of 2025. Sovereign mints around the world are now running 8 to 10-week delivery times. 30 days ago, those same mints were quoting 2 to 3 weeks. The Perth Mint in Australia has temporarily shut down new sales on key bullion products just to catch up on existing orders. This is not a regional supply issue. This is global. Europe, Asia, North America. The pipeline is choked. If the metal isn't already in production, it's not arriving anytime soon. Let me translate what this means in plain language. When paper silver crashed 40%, the people who understand physical assets rushed in and bought at a rate that shattered every historical record. The spot price, the number you see on financial news, is a paper price. It reflects derivatives and futures contracts, most of which will never result in physical delivery. It does not reflect the actual supply and demand of metal you can hold in your hand. Just like fractional reserve banking, where banks don't hold cash for every deposit, the paper silver market trades multiples more metal than exists in deliverable form. That's why you can see situations where the paper price collapses, while physical demand explodes and premiums widen. The two markets are diverging. And when that divergence becomes unsustainable, one of them breaks. Now let's talk about the narrative they're selling you. Markets crashed on Friday because Kevin Warsh is expected to be named the next Federal Reserve Chair, and he's known as an anti-QE, a hawkish, Volcker-style inflation fighter. The story is that Warsh will raise rates to whatever level is necessary to crush inflation and restore confidence in the dollar, and that this will destroy gold and silver because higher rates make non-yielding assets less attractive. This is a fantasy. It is a bedtime story for people who don't read balance sheets. Kevin Warsh cannot be Paul Volcker even if he wants to, because the debt trap makes it mathematically impossible. When Volcker raised rates, the United States was a net creditor with a manageable debt load. Today, we are the largest debtor nation in history with an exponentially growing interest burden. Warsh can talk tough. He can make speeches about sound money and fiscal discipline. But the moment rates rise materially, the Treasury's interest expense will explode and the bond market will force a policy reversal. The math will make the decision for him. And while that narrative was being sold, another massive announcement slipped through. Trump secured a major trade deal with India. India agrees to stop buying Russian oil and switches to U.S. and Venezuelan supply to help pressure Russia on Ukraine. In exchange, U.S. tariffs on India drop from 25% to 18%. India cuts its own tariffs and trade barriers to zero and commits to $500 billion in American purchases. Energy, technology, coal. This is one of the largest bilateral trade agreements in modern history. And here's what matters for commodities. India absorbed roughly 25% of global silver production in 2025. Their demand is cultural, industrial, and inelastic. Now they've committed to $500 billion in U.S. goods, much of it in energy and technology sectors that are silver-intensive. Solar exports, electronics, EV components. Silver is embedded in every part of that deal, even if the word never appears in the press release. India's demand is not going away. It is accelerating. And the U.S. just locked in a $500 billion tailwind. Meanwhile, the U.S. ISM manufacturing PMI just hit 52.6, a 40-month high. The market was expecting 48.5. Anything above 50 signals expansion. This is strong data. Manufacturing is growing. Industrial demand for silver should be rising. Yet silver crashed 40% on the same day. Copper, another key industrial metal, tumbled more than 5%. Does that make sense? When manufacturing expands and industrial orders increase, the metals that go into that production should rise, not collapse. The fact that they moved in the exact opposite direction of what fundamentals suggest is the clearest proof that this was not a market-driven event. It was a coordinated paper dump using the Warsh announcement as cover. And there's one more data point that should terrify you, the Shanghai premium. As I record this, Western spot silver is trading around $29. Shanghai spot is over $34. That's a $5 premium, roughly 17%. After a 40% crash, the premium is still in the double digits. Futures tell the same story. Western futures at $29.50. Shanghai futures at $32. The Chinese physical market is not following the Western paper price. They are paying a premium for immediate delivery because they understand that metal in hand is worth more than a contract that might default. The divergence isn't closing, it's widening. Let me be very clear about the bearish case because pretending it doesn't exist is intellectual dishonesty. This volatility is absolutely brutal if you were trading on leverage. UBS noted that silver's intraday swings approached 38%, with volatility hitting levels not seen in almost 50 years. If you were long on margin, you got obliterated. Natural gas just crashed 25%. Copper is down more than 5%. The entire commodity complex is under pressure. And here's the next shoe dropping. The COMEX just raised margin requirements effective after the close on February 2nd. Gold margins went from 6% to 8%. Silver margins went from 11% to 15%, and under heightened risk, from 12.1% to 16.5%. The Shanghai Gold Exchange raised its margin requirement from 20% to 26%. More margin hikes mean more forced liquidations. If you're over-leveraged and the exchange suddenly demands more collateral, you have two choices: post more cash or sell your position. Most traders can't post more cash, so they sell. That creates another wave of selling pressure, which triggers more margin calls, which creates more selling. This is a liquidation spiral, and it is not over. Add to that the broader macro picture. U.S. stock market concentration is at record levels. The S&P 500 Herfindahl-Hirschman Index, which measures how evenly market value is distributed, is now at 195 points. That is near the highest on record. For context, it peaked at 125 during the dot-com bubble. The market has never been this top-heavy. A handful of mega-cap tech stocks are holding up the entire index. When this breaks, when those few names start falling, the deleveraging will be catastrophic. Pension funds, mutual funds, ETFs, all structured around the assumption that those stocks only go up. When that assumption cracks, the liquidation will cascade across asset classes. Gold, silver, real estate, bonds, everything gets sold to meet margin calls and redemptions. That is the bearish scenario, and it is real. But here is why the bullish case for physical metal is overwhelming. Every major gold and silver bull market in history has had brutal mid-cycle corrections that felt like the end of the world. In 1974, gold corrected 47%. Nearly half its value gone. The headlines declared gold dead. Analysts said the bull market was over, that it had been a speculative mania with no foundation. Then, over the next 6 years, gold ran 734%. The current pullback in gold is roughly 16% from the highs. In the context of the 1970s bull market, this wouldn't even rank in the top 5 corrections. It is noise. And critically, none of the structural drivers have changed. Central banks are still accumulating. Tether is still buying. Debt is still expanding at $1 trillion per quarter. Silver remains in backwardation on futures curves, a technical signal of physical tightness. The 5-year supply deficit in silver has not been resolved. It has worsened. Friday's 40% paper crash triggered a 250% explosion in physical demand. That is not the behavior of a market in equilibrium. That is the behavior of a market where the paper price has detached from physical reality. And here's the historical pattern you cannot unsee. The Roman denarius collapsed because the gap between the official value and the actual metal content became undeniable. The Dutch guilder lost reserve status because debt from endless wars made it unserviceable. The British pound was dethroned because 2 world wars destroyed the gold backing. In every case, the currency didn't disappear overnight. It lost credibility slowly, then all at once. Merchants stopped accepting it. Savers moved to harder assets. Governments tried to enforce value through edicts and capital controls, but the market found a way around them. The transfer of wealth was not announced. It simply happened. The United States is now in the same sequence. The debt cannot be serviced without printing. Printing destroys the currency's purchasing power. As purchasing power falls, trust erodes. As trust erodes, the smart money moves to assets that cannot be printed. Gold, silver, land, commodities. This is not a conspiracy theory. This is observable fact. The $12 billion strategic mineral stockpile is not about national security in the abstract. It is about the government recognizing that in a world where currencies are increasingly unreliable, physical assets are the only real wealth. And if the government is stockpiling, what do you think the people who advise governments are doing with their own money? March is a primary delivery month on the COMEX. That means contracts expiring in March can demand physical metal. The COMEX has 104 million ounces in registered inventory. If standing deliveries, the contracts that actually demand physical, strain those vaults, the squeeze we have been tracking for months could ignite within weeks. The cartel dumped 1.8 billion ounces of paper to avoid that squeeze. They closed 1.127 billion ounces to escape delivery obligations. But they did not eliminate the problem, they delayed it. And every delay makes the eventual break more violent, because physical supply does not expand on command. You cannot print silver. You cannot issue a silver derivative and hope it satisfies an industrial user who needs the actual metal to manufacture a product. The unresolved tension is this: paper can be created infinitely, physical cannot. And we are now at the point where that tension is visible to anyone paying attention. When SD Bullion processes 2.5 times their all-time record in a single day, that is not speculative froth. That is people who understand the endgame positioning themselves before the window closes. When sovereign mints shut down new sales because they cannot keep up, that is not a temporary logistics issue. That is a structural supply failure. When Shanghai is paying a 17% premium over Western spot after a 40% crash, that is not arbitrage noise. That is a market screaming that physical metal in hand is worth more than a contract in New York. You are watching a wealth transfer in real time. It is not loud. It is not announced on CNBC with flashing graphics. It happens in the quiet decisions of central banks adding to reserves, of billionaires converting liquidity to hard assets, of mints running out of blank supply. The Roman citizens who held physical silver survived the collapse of the denarius. The Dutch merchants who moved to gold survived the guilder's fall. The British families who owned land survived the pound's dethronement. The pattern does not change. The sequence does not change. The outcome does not change. This is not about predicting the future. This is pattern recognition. The debt spiral is mathematical. The physical shortage is measurable. The paper dump on January 30th was desperation, not strength. They bought time by crashing the price and scaring over-leveraged traders out of positions. But they did not fix the underlying problem. They made it worse, because now physical buyers who were sitting on the sidelines just got a 40% discount, and they are taking it. The demand spike is not speculation. It is conversion. People are converting paper claims into physical metal while they still can. The smart money is not waiting for confirmation. The smart money is not waiting for the news to tell them it is safe. The smart money understands that by the time it is safe, it is too late. When the Roman denarius finally collapsed, you could not buy silver at any price. When the guilder lost reserve status, there was no going back. When the pound was dethroned, it was already done. This is not might happen. This will happen. The only question is whether you understand the pattern before the outcome is undeniable. Subscribe if you want to see how this plays out, because what happens in the next 90 days will determine whether you were early or whether you were late. And in a wealth transfer, there is no middle ground.